Foreign investors ranging from manufacturing companies to banking institutions have been leaving the Philippines. A decade ago, we saw the largest foreign exit, Intel, an American electronic giant that helped create the electronic industry of the Philippines. A few years after Intel left, Ford, the American automotive company, ceased its production in the Philippines, closing their plant that was producing 35,000 vehicles a year. By 2019, we also saw the bankruptcy of Hanjin Philippines, which was hailed as the largest foreign investor in the Philippines. Then, Citibank, the largest foreign bank in the Philippines, sold its consumer bank to the local company Union Bank, signaling the end of America's financial grasp on Philippine consumers. Such instances are only examples of many more out there. These foreign companies either leaving the Philippines or seeing the bankruptcy of their subsidiaries may suggest that the local economy is either bad or not worth investing in. Does this then imply that the Philippines is one of the worst places for foreigners to invest in? Well, there are reasons why some foreign investors leave. They either leave because of global uncertainty, inadequate local infrastructures, possibly expensive electricity, or other reasons. But to truly understand this, it is important for us to understand each company's reason. Why did Intel leave? Why did Citibank sell its local business? Why did Hanjin Philippines go bankrupt? Only then can we decode why these foreign investors have failed. Let's first start with Intel. Intel was a very important company in the Philippines. They were the first U.S. semiconductor firm to establish a facility, and their total exports up to 2008 amounted to $5 billion US dollars. They were the largest contributor to the Philippine economic zone, accounting for approximately 15% of annual export revenues. The closure of Intel Philippines was not unexpected. There were already reports of the company's intention to cease local operations in 2005. This speculation intensified when Intel opened a new facility in Vietnam in 2006. They further invested significantly in their Malaysian and Chinese facilities. Further, their plant in the Philippines failed to secure additional funding from Intel's $1 billion investment plan for Asia. On top of that, the announcement to close their assembly test facility came after Intel saw a huge drop in its fourth quarter profit. Their profit fell 90% in the fourth quarter, and sales slowed down by 23%. Intel said the closure was part of a broader restructuring plan, which included shutting down similar facilities in Malaysia and halting production at plants in Oregon and California. The cause for its decline in both sales and profit was due to the broader semiconductor industry. The global financial crisis had struck the industry, leading other chip companies such as Advanced Micro Devices, AMD, to experience significant declines. The main reason for Intel's exit was a broader slowdown in the global economy and the semiconductor industry. However, many observers stated that it was due to the Philippines' infrastructure issues. The energy cost was high. Some said that in 2009, it was the second highest just after Japan. Others said that Intel just wanted to take advantage of lower wages in Vietnam, hence why they opened a new facility there in 2006, and subsequently closed the Philippines and a facility in Malaysia. Although Intel's exit was unfortunate, when we look back on it now, the Philippine electronic industry continued to grow. Just take a look at Texas Instruments Philippines, a company that was one of the pioneers in the semiconductor space in the Philippines. They continued to grow and are now one of the largest and most important foreign investors in the Philippines. They took over the semiconductor crown from Intel. Recently, Texas Instruments Philippines announced a $1 billion expansion, indicating their confidence in the Philippines. Moreover, while Intel blamed the semiconductor slowdown, one should never forget that Intel has not really grown since the start of the 21st century. Market capitalization, an indicator that showcases how valuable a company is, has not really grown much since 2008. Way back in 2003, Intel had a market valuation of over $219 billion. By 2008, this fell to $128 billion and was further hurt by the global financial crisis to $70 billion. Yet today, Intel is still stuck with a valuation of $130 billion. For over 20 years, Intel, based on market capitalization, has not really grown. While one can partly blame the Philippines because of high operating costs, One should also not forget that Intel itself isn't a well-performing company. The exit of Intel coincides with why Citibank, the largest foreign bank in the Philippines, left the Philippines. In the early months of 2021, Citibank said it was selling its local consumer and retail business in the Philippines. This means that Citi will cease its local credit card business, retail deposit taking, asset management, and lending services to individuals and households. Citibank was not just any other foreign bank in the Philippines. They were serving over 950 multinational corporations and more than 100 leading local corporations. They were catering to over 90% of the country's 20 most valuable companies listed on the stock market. In 2020, Citi raised over $20 billion from global capital markets for its Philippine clients. Cesar Consing, the president of the Bank of the Philippine Islands and former president of the Bankers Association of the Philippines, said that Citi had built a strong retail and consumer banking business in the Philippines. It was well managed and had a substantial consumer base. Put simply, Citi was needed in the Philippines. So why did they leave? Well, just like what happened to Intel, Citibank is no longer a high-performing company. When they announced their exit in the Philippines, they were also exiting their consumer franchises in over 13 countries. They were leaving South Korea, India, China, Australia, Bahrain, Vietnam, and other jurisdictions. They were no longer capable of being the global brand that everyone once knew and loved. Since the global financial crisis, Citibank never actually grew. In 2006, the company had a net income of $29.6 billion. In 2023, that figure amounts to a small sum of $12.91 billion. Once again, one can try to blame it on the domestic market of the Philippines, but you should not. Citibank itself is just no longer the company it once was. Moreover, when Citibank exited its business in the country, a local company actually rose and bought it. Union Bank, one of the fastest-growing banks, paid a big sum for this acquisition. It cost them over 55 billion Philippine pesos, or about $1 billion US, to acquire the entire business that Citi was selling. This was not a small amount of money, especially since Union Bank is not amongst the 5 largest banks in the country. Yet they mustered up and took the opportunity. This showcases that there are local companies out there willing to take advantage of what foreign companies are going to leave behind, no matter how small they are. The same can be said for Texas Instruments and Intel. T1 took the reins as the leading American semiconductor in the Philippines when Intel left. Then, one can also look at Ford Motor Company's closure of their plant in the Philippines. Back in 2012, Ford said that they would close their assembly plant in the Philippines as part of a restructuring in the region. Ford's decision to close its plant in Santa Rosa was because there was not a strong enough business case for continuing local manufacturing, said the president of Ford Group Philippines. Instead of manufacturing locally, the market in the Philippines will be supplied by importing from other global plants, primarily in Thailand. The move to Thailand may be significant enough to warrant a case for the Philippines. In this scenario, can we blame the Philippines? Well, let's look at it this way. Thailand should have a higher operating cost. The country has higher wages than the Philippines. Yet they still closed the Santa Rosa plant. Why? Well, one can indeed speculate. But if you knew that after 2 years the plant would be acquired by a Japanese company, then you can simply say it's because they weren't performing well in the local market. 2 years after Ford closed their Santa Rosa plant, Mitsubishi Motors Corporation acquired that very same plant. What does this suggest? Simple. They just weren't performing well enough to continue local manufacturing. Further, there are other better companies that are going to eat up what they left. It is not about the Philippines' high energy cost, nor is it due to wages or poor infrastructures. That can be. But it is difficult to say that these are the reasons alone, because other companies are also coming in and taking over what they leave behind. The same is seen through Hanjin Philippines. The company, although never left voluntarily, instead declared bankruptcy. They declared bankruptcy because Hanjin had taken on too much debt. They had over $1.4 billion of debt and could no longer pay it back. On top of that, the name Hanjin had been damaged in 2016, when Hanjin Shipping had collapsed a few years prior to Hanjin Philippines' bankruptcy. A few years later, private equity firm Cerberus Capital Management took over. They revived the shipyard. HD Hyundai Heavy Industries, the world's largest shipbuilding firm, is now one of the new tenants for the shipyard. This again showcases that even if a foreign firm collapses, a newer one, sometimes better, will emerge. But anyway, do let us know what you think. Thanks for watching!